What's your initial take on what's driving today's pullback?
Well, Wilf, I think it's all about growth. Bob hit the nail on the head. Whether you look at China, whether you look at home builder sentiment, consumer confidence, retail sales, even things like a tiny country like New Zealand basically shutting down over, one COVID case. People are worried that there is some type of issue here with the growth. Obviously, the market's doubled in 15 months. There's a lot of good news priced into this market. And so as we, just hit new record highs yesterday, I think when you see a little uncertainty out there, people naturally, especially the weekends, are going to take a little money off the table. And I think that's what today was all about.
You telling your clients to buy the dip? I mean, as you said, it's not much of a dip, 1% from record highs.
It's not much of a dip. And to be honest with you, I mean, we'd be really happy to see a 5 or 7% pullback or something like that, because we think it is an opportunity. I mean, our earnings estimate for this year is $200. That might be a little conservative. Next year it's $220. That might be a little conservative. So while these growth estimates may be coming down in some parts from some of our competitors, I still think they're probably going to have some pretty good earnings numbers out there that are going to support the market. And clearly, we're going to continue to make progress on these vaccines. The Fed is going to remain easy. We're going to have plenty of fiscal stimulus. So for us, we want to lean into this recovery, and we are buying on dips. But as you said, I mean, after the run we've had to cough up 1.5% or a couple of percent, that's not much.
Scott, some are wondering if this has to do with the Fed timeline for tapering, which is coming into clearer focus and sort of hovering around the fall, September, October announcement. But if that were the case, wouldn't the 10-year yield be going up and not down if there was truly a taper tantrum?
Well, I don't really think there is going to be a taper tantrum, Sarah. I mean, the market's very well prepared for this, and certainly at the growth rates we're looking at, or even some of the lower ones that you mentioned some of our competitors have. I mean, should the Fed still be in here buying $120 billion worth of bonds? I mean, we don't think so. So, we don't think anything's going to happen at Jackson Hole. We do think we'll probably hear a timeline at the September meeting. But a few months here or there, I think the bottom line for us is that we're going to see a tapering process start either late this year or early next year. It's probably going to be strung out over the course of 12 months. So I think realistically, if you take into account what's going on in the U.S. economy and the global economy, that makes some sense. So a few months here or there, I don't think the market's going to get too worked up about it. And really, as far as yields go, you could make the argument that if people think that the Fed is going to step in here, it's going to get a little tighter sooner, although I hesitate to use the word tight. The foot's going to be off the accelerator a little bit. That might actually, pressure bond yields for lower growth. It'd be more of a headwind for the economy, which would imply less inflation possibilities and possibly some slower growth. So I think that yields should be higher. Don't get me wrong, but I think the rationale that the Fed hikes rates and rates go higher, I'm not sure that holds water all the time.